Welcome to our series on Focus on 401k's, Securing Your Financial Future. I'm Renee Lewis, co-founder of Lewis & Palmer. I hope you're all doing well and staying safe. So last video, we discussed the importance of contributing to a 401k and pre-tax and after-tax contributions. This week, we'll discuss what investment options are typically available in a 401k. So let's start with asset allocation funds and target date retirement funds. So asset allocation funds aim to balance risk and reward according to an individual's goal, risk tolerance, and investment horizon. So what is risk tolerance? It's the degree of risk an investor is willing to take in their investments. Investment horizon is the length of time an investor will hold their funds before they sell them. So for example, if you have a conservative risk tolerance, maybe you're worried about the markets going up and down, or you're retiring next year, or maybe you just have a short-term time horizon, you may want to invest in a conservative asset allocation fund. On the other hand, if you have 30 years until retirement and you're not worried about the volatility in your account over time because you believe you will average a greater return by having an aggressive risk tolerance, then you may want to choose an aggressive asset allocation fund. Asset allocation funds are designed to be conservative, moderate, or aggressive, and they'll stay that way over time. Target date retirement funds work a little differently. These are the funds that have a date listed in the fund name, like Target Date Fund 2040. Typically, you choose the fund that is closest to your retirement date. Target date funds will start out more aggressive when there's a long time before that stated retirement date. But as that date gets closer, the funds will become more conservative. In other words, when you have many years to invest, the fund will be aggressive to get growth and could be invested in as much as 90% in stocks. But when you are due to retire in 5 years or so, it becomes more important to conserve rather than grow. So the fund will gradually shift to bonds, ending up in as much as 80% in bonds. So okay, let's talk about mutual funds. Mutual funds are large pools of money from thousands of investors, which are managed by professional portfolio managers. These managers buy and sell stocks, bonds, and other assets every day. They allow for an investor to have a more diversification than if the investor bought an individual stock. So if all your money was invested in Apple stock and Apple stock went down 50%, you lost 50% of your money, right? But if you invested in an S&P 500 mutual fund that had a small percentage of its holdings in Apple stock, but also holdings in Amazon, whose stock was going up, you wouldn't see a 50% loss in your holdings because Amazon brought the price of the mutual fund up. So not all funds invest in the same types of stocks or bonds. So do some homework and talk to your plan's financial advisor for more information. The great news about investments in a 401k is you get to choose. Whether you are a novice at investing or very knowledgeable about the market, there are money funds available to you. Again, talk to your plan's advisor for information and advice or to address any questions you have. We are always here to answer any questions you may have, so please give us a call. Next video, we're going to discuss how much you should save in your 401k. Renee Lewis, Lewis & Palmer. See you next time.